Hello folks, I'm Trev Makes It Easy, the channel where we make learning easy. In this series, Trev on Econ, I'll be taking you through topics you're likely to run into in any introductory course in economics at the college or university level. My goal is to make economics less scary, more approachable, and, if I can, mildly enjoyable. With that being said, let's make it easy. All right, folks, let's get started. This is going to be our first video leading into the macroeconomics branch of economics. So if you're in a macroeconomics course, this is a great place to start. If you're in micro, don't worry, we'll have videos for that coming. Now, today we're going to start off with one of the key pieces of macroeconomics, which is GDP. And if you're not familiar, GDP stands for Gross Domestic Product. Now, GDP has a very specific definition. A lot of the times in my videos, I will present a definition and put it in more plain English. This is one of the cases where we're going to use a very textbook definition for GDP to make sure we're really catching all the nuance. So GDP's definition looks like this. It is the market value of all final goods and services produced within a country in a given period. Now, this again is one of those definitions you are going to want to know word for word. It's often tested in a very strict format to make sure you're hitting all these key points. Now, you can't really see it yet, but this sentence is made up of many pieces that tell us a lot about this topic. So we're going to go through and break this sentence down a little bit. The first thing we have to talk about is the term market value. And this simply means that we are looking at what things are actually selling for. All right. We're going out into the marketplace. We are seeing, what are different goods and services selling for, and we're going to value them based on actual prices we're seeing. This is to provide a fair comparison. We don't want people just making up prices that they think things should be selling for. We want to know what they are actually selling for. The next piece is all final goods and services. So right away, it's goods and services. Okay, so we're not just talking about stuff that is being made, we're talking also about services being provided. But you'll also notice it says final. And final just means the value of the goods and services that are sold to the end customer. Now, by end customer, I mean people who are going to buy that product and then use that product in consumption. By that, I mean they're not going to buy it, modify it, and then resell it. All right? You can think of this as products that have ended the supply chain. They have reached their final or end customer and are no longer going to be sold again in any sort of way. This is going to create some exclusions later that we'll talk about, but for now, just understand we're not counting every part of the process. We are just counting the end result. All right. The next thing is produced within a country. All right. So what we mean by this is we are only counting things that are produced within the country we're looking at. I'm just going to say GNS for goods and services. Again, this is going to create some exclusions later, but what this effectively means is it doesn't matter what nationality the company is, it matters where that company is making the good. So for example, I'm in Canada, so if I was looking at Canadian GDP, I would count a Chinese company that has made something in Canada, but I wouldn't count a Canadian company that has made something in China. It matters where it was made, not who made it. And then the final thing is given period. This just means that the GNS has to have been made in the time period we're looking at. All right. So again, what I mean by that is if I'm looking in 2025 when this video was being made, I can only count goods and services that were finished being made in 2025. That again is going to create some exclusions that we're going to look at in a moment, but you can start to see this very simple sentence of gross domestic product is a lot more in depth than it maybe initially looks. Overall, okay, GDP is a measurement of production. Okay, gross domestic product, it is production. All right. We have to be careful. In economics, some people tend to try and extrapolate GDP and make it mean a whole bunch of other things, but it doesn't do a lot of that. And we're actually going to spend a lot of this video talking about not necessarily weaknesses, but helping you understand that GDP does not include a lot of things. And because of that, it has some inherent weaknesses, and we can't just blindly assume this is some sort of perfect economic measure, right? So let's start there. Let's start with what does GDP ignore, all right? Or what will we not include when we tackle a GDP problem? So GDP excludes a whole host of things, right? Again, it's probably one of its biggest weaknesses, if you can call it that, but things that GDP does not include, okay? In general, it includes all final goods and services, again, produced within a country in a given period of time. That's a broad range. But within that broad range, there are certain areas that we cannot include for various reasons, right? So the first thing is intermediate goods. Intermediate goods, in opposition to final goods, these are goods created during the process of production. So for example, maybe I mine some copper, and then that copper gets turned into copper bars, and that copper bar gets turned into a sheet of copper, and that sheet of copper gets turned into, I don't know, copper wire. We cannot include all these various aspects. We can only include that final product. All right. So we do not include intermediate goods. These are parts of the production process that are incomplete or will turn into something else later. Okay. It can be difficult to identify these. You have to read questions carefully, but you have to ask yourself, are these goods that are going to be changed into something else and then sold again? If that's true, we cannot count them. All right. So again, that copper ore, we can't count. That copper bar, we can't count. That copper sheet, we can't count. The copper wire, we can count because that is the final good in this example, right? The next thing we exclude is used goods. Okay. If you remember, we said that we only count things in that given period. So if I'm in 2025, I can only look at goods produced and services rendered in 2025. All right. So the GNS, or sorry, any GNS made in the past. Right. For this one, I'm going to highlight two specific goods because there's two goods that people like to use as trick questions on tests. And that is, watch out for houses and cars. Okay. This one is a common mistake for people because houses get counted in the year they were made. So if your house was made in 1990, it was included in GDP in 1990. But if you resell the house in 2025, you can't count it. You haven't produced anything new. All you've done is switch ownership. So watch out for that. Watch out for the years. Same thing with cars. If I have a 2010 Honda Civic and I don't know, sell it in 2025, it doesn't get counted in 2025 because it's already been counted in 2010. Both of these issues actually have the same problem, and that's what's called double counting. Now, if you're in accounting or done accounting courses, you might be familiar with this, but we cannot count the same thing twice. So for example, in intermediate goods, we don't count the copper or the copper bar, the copper sheet, because all of those things are included in the price of the copper wire. So if I count the copper wire and those things, I'm counting these pieces twice, which I'm not allowed to do. Same thing with the houses and the cars, the used goods. I counted them in 2010, 1990. I can't count them again in 2025 because then I'm getting 2 counts of it. All right. Watch out for these. These are probably 2 of the most common things you need to watch out for. And teachers love to throw these in and hope that you will cross them out. And students sometimes forget to. So always ask yourself, is it intermediate? Is it used? Some smaller ones to watch out for. Domestic companies producing in foreign countries. We briefly talked about this, but if I'm doing the GDP for Canada, I can include a Chinese firm making stuff in Canada because they're in Canada, but I cannot count a Canadian firm producing in China. That would be in Chinese GDP. All right. So again, it's the location of where it's produced, not the producer's origin. It also doesn't include financial assets. So if you buy stocks or bonds or derivatives, that is just changing the format of money. Okay. You are not actually producing anything. You haven't made a stock or you haven't made a bond necessarily. All right. So because of that, watch out for financial assets. They are also not counted here. They're counted other places. And like the service to buy and sell, like if you have a stockbroker or someone who's doing financial planning, that would count because that's a service rendered. But the actual purchase of a financial asset does nothing. Also, things we call non-market activity. This one is just anything that is unpaid in the market. So this would be things like housework or volunteer work. These are activities where you are producing something of value, right? You cook, you clean, maybe you volunteered at an animal shelter. These do produce value, but because there's no money associated with them, there's no market for them. So we just don't know how to record these, right? You don't have to submit a form to the government being like, I volunteered 40 hours this week, because there's no payment involved. And if there's no payment, there's no paperwork. And if there's no paperwork, there's no real way to track it. And then the final one is the underground economy. So this is usually things like illegal activity or cash sales. All right. And that's usually to avoid taxes. These are things that, again, you are trying to hide from the eyes of the government, so you don't really want to leave a paper trail. And if there's no paper trail, they can't really record it, so we have to be careful of that. All right. Again, this is not an exhaustive list, I would say, of all the things you could exclude, but this is probably the majority of the ones you will often see, especially in introductory macro courses. All right. Keep an eye out for them. They will pop up as tricks. And this is definitely a section of course where you can run into a lot of tricks, which some students don't love. But if you're at least aware of them, you will look out for the tricks more so. All right. Now, the next thing I want to quickly talk about is GDP being that measure of production. Okay. So we've already said that GDP is a pure measure of production capabilities. I should say production. Okay. What sometimes happens is people will conflate this and try to give it more meaning than it actually has. And one thing I want to make very clear, GDP is not a measure of well-being. Okay. GDP does not say how good a country is or how happy it is. It purely says how productive a country is. And the reason it doesn't measure well-being is because in terms of, again, things that GDP doesn't include, there's also just things it straight up ignores and can't account for. Okay, so by that I mean it doesn't account for things like leisure time, right? One way to get your production really high is just make people work longer. What if instead of a standard 40-hour work week in North America, we instead said, nope, everyone works 60 hours? You're going to get a higher GDP most likely because people will be more productive. They're making more stuff. They're working longer hours. But are they happier? No, I would imagine not. Most people don't love working 60 hours. It's a lot of your week gone to work. It doesn't include things like environmental impacts. Guess what? If you want to up your GDP and make stuff, well, make it cheap. And when you make things cheap, what happens? You tend to produce a lot of environmental impact. Things like smog, things like carcinogens, things that are going to poison the environment, because caring for the environment is expensive, and expensive means less production a lot of the time. It also doesn't include things like income distribution. Right? You can be a very productive society, but maybe the results or the payoff of all that production are going to the top 1%, right? We hear that phrasing a lot in the news. Just because a country has high GDP doesn't mean everyone is benefiting from that GDP equally, all right? This does not mean that GDP is bad, okay? There are other things we could talk about in terms of it not being a measure of well-being, but it just has to be used in context, which means you have to understand it is a measure of production. It is not some magical number that says, I am a better country because my GDP is higher. All right. There are countries with very high GDP and very low well-being. There are countries with very high well-being and low GDP. They are not necessarily correlated. Sometimes they can be, but causation and correlation is not necessarily there all the time. Okay, so again, understanding the value of a variable is important, but it's also important to understand the limitations of a variable. Now, the follow-up question becomes, well, why do we still use this? Okay. Okay, why have we not made some magical, better variable that captures all these things? Well, we've tried. There's some other measures that do capture things like leisure time and are probably better indicators of well-being, but then they miss out on the production side. So GDP is still valuable because it does do a really good job at what it does, measure production. So what does this do? Well, one of the things it's very useful in, it's used a lot in policy decision making. Throughout the macro lessons we're going to get into, policy is going to become a big topic, especially for introductory level. And understanding the impact that we will have on GDP when we make a policy decision is one of the fundamental pieces of quote-unquote good policy. It's also useful in identifying sections of the business cycle. Okay. Often in the news, you'll hear, oh, we're in a period of growth or we're in a recession. When people say those things, they're referring to changes in GDP. So it's important that we have a measure that helps us indicate where in the business cycle we are. We haven't talked about the business cycle yet. You might have some broad ideas about it. We will see it in a later video. Finally, it's just a really good comparison tool. Okay, it's something that we can use to look at different countries and say, this country is producing more than that country. All right, or this country is producing more than itself last year. It's a good measuring stick for the production capabilities of a country, and we tend to use that as a measurement of economic growth, which, as we saw in a much earlier video, economic growth is going to be important. All right, we will have a very large section of this macro where we talk about growth, because at the end of the day, that is kind of one of the big tools or goals of economics, is we want to grow our economy. All right, GDP gives us a way to measure that. It's quite useful, to be honest. Now that's going to wrap up part one for us. In the next video, we're going to talk about different approaches to GDP. That's how we actually measure GDP, get a number for GDP, and start to begin our calculations. After that, we're going to go into a math lesson where we look at the numbers behind GDP and work our way through a large problem that covers sort of all the general types of GDP questions you're likely to run into, again, in an introductory course. I hope that was useful. I'll see you next time. Bye-bye. Well, folks, that wraps up another lesson for today. I hope it was helpful. If you found the video valuable, please make sure to like and subscribe. And if you have any questions about the content or requests for other topics or subjects you'd like me to cover, please leave a comment below. Until next time, keep learning and make it easy.